Okay, what's up everyone? This is Scott here again with my next live trading video. Today is Thursday, April 14th, and in this one here, I'll be showing you guys how to correctly put on a poor man's cover call position. And I do want to emphasize correctly because since the poor man's cover call only deals with options, there's going to be some key differences between that strategy and the regular cover call. And as a result of that, if you do things incorrectly, you might find yourself actually losing money in some situations, whereas with a regular cover call, you would actually be making money. And so the underlying I'll be using to show my example here is going to be none other than SPY. This is an ETF that tracks the S&P 500, and it's basically the most liquid underlying in the entire stock market. Now, of course, you certainly don't have to trade SPY with the poor man's cover call, but it is very important to actually trade a very liquid underlying because, as you'll see here, part of this poor man's cover call position does require you to trade options with very, very far dated expiration dates. And as a result of that, if the underlying itself or the option markets as well are not very liquid or not very actively traded, then it's going to be very difficult to get your orders filled and also at good prices. And also the second reason why I'm choosing SPY here is because it is a very expensive product, right? Currently, SPY is trading at over $440 per share. So this makes it a great candidate for a poor man's cover call, which is going to require significantly less capital than a regular cover call. And of course, that's where the strategy here gets its name of the poor man's cover call, right? It simply means it allows you to mimic a cover call, but with significantly less capital. Now, as always, before we dive in though, in case you are brand new to the channel, again, my name is Scott, and I just want to let you know that you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Okay, so let's dive in here now. And first off, we'll take a closer look at the charts here. So we'll zoom in on SPY. So obviously, as you can see here, as of the recent past couple weeks, we've undergone a bit of a sell-off. And currently, we're kind of hovering around the support level right there, which you can see in white, basically at the lower end of this pretty nice range right here. So this is also a third reason why I wanted to show the poor man's cover call on SPY here, because just like a regular cover call, this is a bullish strategy. So ideally for me at least, I would want to use this kind of approach on any stocks or an ETF in this case that has come down significantly in the recent past. So with that being said, we'll now come over to the trade tab and take a look at the option chain here on SPY. And so with the regular cover call, right, there are two main components. You have the long stock component where you buy 100 shares of some underlying. And then the second component is you sell a short call option with a strike higher than the purchase price of that stock. Now, the issue with that, of course, is sometimes, like in the case of SPY here, that's very expensive. Buying 100 shares of this underlying is going to require over $40,000. That's a lot of money. So again, like I mentioned, the poor man's cover call is very similar to a regular cover call, but it requires significantly less capital. And the way it achieves this is by, instead of purchasing 100 shares of stock, we're going to buy a long call option that's super far in the money and that also expires in some decent amount of time, typically at least 6 months, but perhaps a year or even 2 years could also be very good as well. So for the purpose of this example, I think for my long call option, I'll go into the December 16th, 2022 expiration cycle with 246 days left to go. So again, if today's date is April 14th, 2022, then that means this expiration cycle expires in about 8 months. So that's a bit on the short side, but still definitely good enough for this kind of position. So we'll unfold this tab here and take a look, and we'll scroll down a little bit here. So keep in mind that if the current price of SPY is about $441 per share, that means any call option with a strike below, let's say 440, all these call options here in blue, these are all in the money options. And these are the ones you would want to purchase as part of the poor man's cover call position. Now, in terms of which exact strike, for me, I typically would like to go at least to the 80 delta option. So as you can see in this column right here, these are the deltas of all these different contracts. And basically the bottom line here is the higher the delta, the more like a long stock position these options are going to behave like. And of course, that's the whole point of buying these far in the money call options. We want to mimic a long stock position, but also without having to pay for the full 100 shares. So in this case here, this 80 delta call option with a strike of 360, the cost of this option, if you take a look at the bid and ask prices and go basically right in between here, it's going to cost around $9,200, which still is a decent amount of money. but obviously it's far, far cheaper than buying 100 shares of SPY outright and paying over $40,000. $44,000 to be exact. So now at this point, I'll go ahead and click on the asking price for this contract, and that brings up a buy order down below. Just gonna buy one contract of the 360 strike call option, again expiring on December 16th, 2022. And it looks like the fair price for this contract is about $9,265 or $92.65 on a per share basis. So we'll lock in that price, then go to confirm and send. Obviously, because I'm buying an option here, the buying power effect is the exact same price, $9,265. So we'll go to send. And there we go, just got filled at $92.91. Had to come up a bit more in price there. And of course, the reason why I had to do that, why I had to increase my price there, is because with these super far expiration cycles, there's not a lot of volume or trading activity even for SPY. Right? Just take a look at this volume column here, which tells you how many of these contracts were traded just today. And there's simply not a lot of trading happening in this expiration cycle. So of course, also that's why the bid-ask spreads here are a bit wide. And therefore, most of the time, you'll have to give up a few bucks to get filled on your orders here. Great, and so with that being done, now we're on to the second component of the poor man's cover call, which is the same as a regular cover call, in that we now have to sell a short call option that's also in a much sooner expiration cycle. So for me personally, I typically sell options in general with around 30 days left to go until the expiration date. So that means coming back up here to the option chain. Let's scroll up. And as a result, I think I'll go into the May expiration cycle here with 36 days left to go. We'll unfold that tab and scroll down a bit. Now this here is also where things can become a bit tricky, because unlike a regular cover call, where once you buy the stock, it does not really matter at which strike you sell your short call option as long as it's out of the money. But for the poor man's cover call here, that's not necessarily the case. And that's due to the fact that because we are buying a long call option and not purchasing shares of stock, with options, right, we do have extrinsic value, which as an option buyer, you're always going to lose that. Right, basically every time you purchase an option, there's always a component of the price you pay to buy the contract that you're essentially going to light on fire and lose that money over the course of the expiration cycle. So the bottom line here is you want to make sure that you pick your short call option strike such that if you do get assigned on it at some point and therefore have to exercise your long call early, that the net result of doing all that is you actually walk away with a profit, just like a regular cover call. So let's walk through a few examples of this so you can see exactly how it's all going to work. So for example, in this May expiration cycle, let's say I wanted to sell this 460 strike call option for around $200 as a starting credit. Now before I sell this option though, I need to do some math to figure out what would the outcome be of this whole poor man's cover call position if, let's say, by May 20th, SPY was above $460 per share and I got assigned on this call option as a result. Well, to do that, let's go ahead and pull up the calculator real quick. And I'll move this right there. So again, keep in mind the strike of my long call option that expires in December has a strike of 360. So once more, if I get assigned on my short call option by the May expiration date, at that point, I'll have to exercise that long call option early in order to basically cancel out what's going to happen to me once I do get assigned, right? Because getting assigned on a short call option means I'll be entered into a short stock position. I'll be short 100 shares of SPY, but then exercising my long call option means I have to buy 100 shares of stock, which therefore closes out that short stock position. And in the end, the net result there is I completely exit the poor man's cover call position. So again, let's say all that happens, I get assigned on my short call here, and therefore I exercise my long call. And as a result, I would purchase 100 shares of stock at a price of $360 per share. So I'll make that a negative number because that's of course going to cost money. And in doing so, that will close out my short stock position that I'm entered into at a price of $460 per share. And therefore I make a profit on the stock of $100 per share times 100 shares. That's an overall profit of $10,000. Very nice. But now from this number, I have to subtract the cost that I paid to purchase that long call option in the first place. And as you saw a moment ago, my fill price was just shy of $9,300. So from $10,000, we subtract $9,300, and that means now I'm left over with a profit of $700. Moreover, as a seller of this option right here, of this May contract, I do always get to keep the premium I sold it for at the beginning, which is about $200 or so. So finally, we add the $700 200 bucks of credit. And that means if this was to all play out, I would walk away with a profit still of 900 bucks. Very nice. So therefore, this means I can definitely sell this 460 strike call option right here, no problem. Basically, the strike of this contract is high enough such that, again, if this kind of situation played out, I would still walk away with some sort of profit, which would also happen with a regular cover call, and if I instead purchase 100 shares of SPY. Right? Don't forget, the cover call strategy or any form of it is meant to be mostly a bullish strategy. So you want to make money when the price of the underlying here does increase. Now conversely, what if instead of the 460 strike call option, what if I sold the 442 strike, basically right at the money? Obviously, I would collect a much higher credit here, basically over 1,000 bucks. But if I did get assigned on this contract, what would be the outcome of the entire position? Well, let's bring back the calculator here and we'll find out. And let me move this a little bit. There we go. So now if I got assigned on this call option, again, I would exercise my long call with a strike of 360 bucks. And that would be the purchase price of those 100 shares of SPY, which in turn would close out the short stock position from getting assigned on this call option right here. And of course, the price at which I would be entered into that short stock position is 442 bucks per share. So we add 442, and that means on the stock, I make a profit of 82 bucks per share times 100 shares. That's an overall profit of $8,200. So now the next step here is to subtract the cost of my long call option, right, which was right around 9,300, which now leaves me at a loss of $1,100. And then finally, I do still get to keep the premium for selling this 442 strike call option, which is right around 1,000. So we add 1,000. And in the end, the final result is still a loss of about 100 bucks. That's not good. So once more, before you sell the short option part of the poor man's cover call, do these kinds of calculations to figure out what would happen if you got assigned on that call option. And based on the results of these calculations, that's how you can figure out which strike is best for you. So for me, in this example, I'm still going to stick with the 460 strike call option right here for about 200 bucks in premium. So we'll go ahead and click on the bid price now to bring up a sell order down below. Just going to sell one contract, and I'll try and do so for a price of around 210 bucks as a credit. So we lock in that price and then go to confirm and send. And notice here how the buying power effect is 0 because thinkorswim knows that because I'm already long a call option in a December cycle, that means any losses on this call option are covered by that long contract. So finally, we just go to send. And there we go, just got filled at exactly 210. Awesome. And so there you go. That's the initial entry for a poor man's cover call position. And at this point, all I have to do is wait until the May expiration cycle comes around. And if by that time, let's say my short call option here is still out of the money, then great, it'll expire worthless. I'll keep the full 210 bucks in premium, and I can do the same thing again, except the next time I would do it in probably the June expiration cycle. And also, one more key thing to understand here about this strategy is the more times your short call options expire out of the money, obviously the greater and greater the total credit you have collected is going to be. And as a result, the more credit you can collect over time without getting assigned on your short options here, the less you have to worry about choosing your strikes with extreme care, right? Because eventually you would collect enough total credit such that you could sell at the money call options if you wanted to. And even if you got assigned on that call option, again, that total amount of credit would be enough to bring the outcome of those calculations to a positive number. So basically the bottom line is the more credit you collect over time, the lower and lower and lower you can sell your call options and therefore collect even more credit with each option you sell and not have to worry about actually losing money if you got assigned on those contracts. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.